All right, guys, this is Wade here. I want to thank you guys so much for being on the webinar this morning. Um, just want to just do a quick mic check. Can you guys hear me all right? You just type in a Y in the chat would be fine. So make sure we're good to go on sound. All right, thanks, Brett. Good to see you on too. All right, thanks again. Appreciate it. All right, looks like we're good to go. So I'm going to introduce Shane again this morning. Shane's going to be taking us through the volatility report for last week and this week, and basically just kind of comparing what happened and then what we're looking at to happen this week. So he spends a lot of time researching those reports and putting those together. So he's definitely the best one to walk through what went through. I obviously, me and him review them before they go out to talk about the ideas behind them. But anyway, he's the key person in initially finding the pairs. So anyway, take a minute and listen to his thoughts on that. And then in the meantime, as he's going through the volatility report, this is also a training webinar for those of you guys that are new with us. If you guys have any questions about the software, questions about specific markets that you're trading, specific setups, you guys can type in those questions. I normally can't get to all of them because we like to keep this webinar around an hour or so. What I do ask is if you do have a question about a market, if you could tell us the market and then tell us the entry time frame and the supporting time frame that you're using to trade that market. Make sure we have that information. Otherwise, I'll probably skip over the question because just can't we can't get to it if we don't have all the information so we can pull it up. So we need 2 time frames and we need a little description of what you're looking at and the currency pair, obviously. So and then any other kind of basic questions. If you guys have support related questions, one thing I do want to quickly mention before Shane comes on is that we're having a little bit of a delay. I don't know if it's with everybody. We need to research it, but with our license keys are sent out through a company called Zapier. And that's what does the calculations and everything to send out the license keys. And I think that they're running a bit slow for some reason. So if you guys have tried to get a license key here, it's taking a little bit longer than normal for them to go out. Some of them seem to be going out fast, and then some of them, have taken up to like 3 hours, 4 hours to send out. So anyway, we're working on that. So I apologize if you guys have experienced any of that, but it's not really, there's nothing's changed on our end. It has to be from Zapier. But anyway, any support related things, please send to support@TradeATS. This webinar is not really designed to help you guys get set up with software or anything if you're still in that phase. But any questions about the markets, that's what it's here. What this webinar is for is to help you guys understand the software, understand what the lines mean, and get the basic strategy under your belt. So with that being said, I'm going to turn it over to Shane, and he's going to take you through those volatility reports from last week and this week, and then I'll get on and as soon as he's done, and we'll answer some questions. So, all right, Shane, take it away.
All right, thanks, Wade. Just a quick little sound check once more. If you could hear me all right, just type a Y into the chat. Beautiful. Okay, so anyways, like Wade said, I'm going to be taking us through the volatility report. This one, so last week, I'm sure a lot of you noticed that we only had 2 pairs on it. It was brutal finding something that was, fresh out of the box. So just to kind of reestablish what the volatility report is about, it's not about a pair that's already moving. Like, I'm sure a lot of you were like, how come they're not adding gold to it, over like a week or 2 ago when gold was really running? The volatility report is to show you stuff that is about to start going, not something where it's already gone. Where gold, I mean, it was fairly obvious that had been running for quite a while. Same with euro dollar. Euro dollar had been running and has whipped up and down and it's had a lot of good movement, but it wasn't something where you could potentially be at the start of a new move. So that's kind of what the volatility report is all about. Just things that are just fresh out of the box, and then on top of that, we like the way that they look, not only fresh out of the box, but fresh out of the box and looks like it's got some good things going for it. So anyways, now that I've kind of gone through what this is, let's go ahead and start with euro pound. So this one was interesting. On our weekly chart, we can see that we had a rotation. We went and took out a sell liquidity line here on the weekly, and then started rotating off of this older weekly average price line. That, and then we had a box that we went through and then started pushing down. So those two things put together are usually a pretty big indication that we're going to be in a short market, especially that weekly. We can still whip around and everything. It's not just a click in and leave it up, but just watching it. Let's go ahead and look at it. So euro pound, we did have a little bit more, a little bit of action to the short side since the volatility report got released, but this is actually ideal. So we've come down, we can see that we've got a bias to the short side. We're taking out all of these buy liquidity lines, these green buy liquidity lines, which kind of lets us know that, it's more so trending than not. You'll notice a lot of times when things are just whipping around and it's taking out both sides of liquidity, that you can't really get your arms around the direction. But as soon as it takes out this sell liquidity right here, starts pushing down, and then we can see we're just actively seeking out new levels of buy liquidity. So right here, we're also not getting a sell liquidity line. So I'm, as far as we can tell right here, we still have that bias. So I'd be expecting this just to be a little bit of a breath and then come down and start taking out some of these other liquidity lines right up until it tells us otherwise. So, and I'll go over what the otherwise would be in a second. All right, let's go ahead and jump over to Canadian versus the yen. So on this one, you'll notice we have no directional bias, and that is because it is broken out of the box and it is actively, or at least when we released this, it was actively reacting to the latest daily expansion line. So let me go ahead and pull that up. All right, I looked at this one beforehand and we actually had a handful of good entries in here. So when we took the screenshot, it was again actively reacting to that. And this line right here, when you break out of a box, is really key for deciding what the direction is going to be. You can get, you can just look at the candle color, but if you can find on a higher time frame a real clear reaction to an expansion line, then that can really help you have some confidence to whatever directional bias. On a larger time frame like the daily or something, the candle color is still going to be useful just because it's an entire day and you can have that could be a lot of movement in there. But having a reaction to an average or a expansion line is going to be one of the best indications of direction you can get. So I mean, anyways, we had a little bit of a reaction to this one right here, came down. Anyways, so here we are at the bottom of this range, and I wanted to go and break through, how you really trade this, and point out that I just saw a few pretty straightforward entries here on the 15-minute that I wanted to break down. So we saw that we pushed through the top of the box and then we started coming down. When you are fresh out of the box and you start whipping around, you can expect that in expansion, the direction is not always just going to be so straightforward. So you can get a little bit more creative in trading through this. But anyways, some entries that came up that I see right here are after we pushed up, we took out this final sell liquidity line, went into a box, and then started pushing down. So we had a little bit of a reaction right here to a past 15-minute expansion line. That actually could have been a way to manage risk if you wanted to try a long position. Again, whenever you have a bounce off of expansion lines, that kind of lets you know that orders at that level are being protected. So we had a bounce off of that, came down, it retested it, but never went through. So you still would have been in that. And then we came up to this. So this is always a real important thing. that I always try to get across for any of you that have, emailed into support asking about a trade. So when you're in a trade and you're expecting an overall direction, so at this point it would have been fairly reasonable for you to still be looking at this to the long side, and you see price go bounce and rotate off of an average price or an expansion line like this, that's a really, really big indication that you should probably be closing your trade out. So what that tells us is that the sell orders that were placed inside of this contraction are now being protected. Excuse me. So we had a rotation off that, and then we also came and did not break through this sell liquidity line to the high. So that tells us two things: one, that the sell orders are being protected, and two, that they're, the bias to the sell liquidity lines is over. So up to this point, we had 1, 2, 3, 4 sell liquidity lines that we broke through. And then we had an opportunity to do so, but we simultaneously rotated off expansion and, didn't take that out. So that's a big indication of, some future movement. It wouldn't do that if there wasn't something going on. And then of course we can see what that going on was. Came back down, and then we had another rotation off of that same, or the following expansion line after this move took place. And this move right here had already established that we were protecting short orders or sell orders. So then we came down and then rotated off of it once more, and that's just all big indications, and then started taking out some of the sell liquidity. So anyways, there was, just wanted to point out that there was a way to get into this. It's still being a little bit whippy through here. Technically it hasn't come back to that point, but anyways, and then that looking at that setup of where you have a rotation on average price and it doesn't take out a liquidity line of the opposite color, it starts, maybe backing off of one. That's usually a pretty good indication on all time frames of, some movement up and coming. So you can find that all over the place on the hour, on the daily, on the 4 hour, everything. And again, it's usually a pretty good indication of what you can expect in future movement. Anyways, let me go ahead and jump over to Aussie CAD. Aussie CAD. Okay, so we had a long directional bias. I checked on this one. I believe it did pull back a little bit. But I just looked over at the 4 hour and saw this bounce right here. That's really clean. Those 4 hour average price rotations, you can say that I have a little bit of a type. I really like seeing those because it's as far as understanding the order flow and why the whys of how price is moving, it doesn't get much more clear than that. It just tells us exactly what orders are being protected. There was a very easy chance for price to just snap down and clear those out, but instead it had like a nice little rotation and then just starts cruising our direction, and you can even manage your risk off of that. So Rick asked, what do you mean protecting sell orders? What does it mean to protect the orders? Basically that they're kind of leaving it on the table, because remember that those lines represent all the orders that were placed inside of contraction. That's what the expansion lines mean, or they just represent a big amount of orders. There's a lot of orders placed at those levels. So the expansion lines are kind of the balancing point for market makers managing their book of business, how many longs and shorts they have. So if you have a rotation off of it to either direction, a lot of times that kind of signifies that they don't want to get rid of a certain type of order yet. Does that answer, or does that kind of explain it a little bit better? And then on top of that, not taking out a certain type of liquidity, then that's just kind of the second, little indication. Just gotta notice, can't hear me very well. Is everyone able to hear me all right? Just checking.
Sound is good on my end.
Okay, cool.
So
I just moved the mic a little bit closer. Hopefully that'll help. Anyways, so let's go ahead and jump over to Aussie CAD and just review that for a second. And we'll go through some of that. You'll notice a lot of the pairs on the volatility report will be on like the daily and the 4-hour, but I wanted to go through and maybe look at a few entries on the 15. Yeah, I like to look at it on the 15 just to make sure that we can take a look at some entries. Aussie CAD. All right, so Aussie CAD, we had some interesting stuff going on with this one. Here, let me pull up that 4-hour move that I was talking about before. Wait, was that on Aussie CAD? Yeah, right there. So this is kind of what I'm talking about with these expansion line trades. So this is a 4-hour chart. There's a lot of good trading right in there. If you're able to get in, somewhat in this area, it's a little bit higher risk. Well, definitely a lot higher right here just because of how much volume. But you can even, if you're able, the closer that you're able to get into this expansion line, the tighter your risk is, because you can basically just manage your risk right off of these, because that's kind of the tipping point that's showing you what some of the future movement can be. Anyways, let's go ahead and jump over to the 15 and take a look at this. Yeah, it looks like we had a little bit of a fake out right there. This started getting very, very whippy though. Yeah, we had a little bit of a fake out and then it rotated off of it and then ended up taking it out. So it was a fake out for a moment, coming right down to that liquidity line, pulling back, and then ended up taking it out. So anyways, why could we be turning on this pair? Well, we see that we had a slow march right up to this liquidity and took it out. That's always something that is that can be a little bit something just to pay attention to. When you have a big block of no liquidity, so we came out and basically took out the highest liquidity line in this range that we've got going on right now. There isn't one for about 130-ish pips away. We took that out and then started pulling back pretty hard at that point. Doesn't always mean something, but it's something that you want to pay attention to, because it would really have to get some steam pretty shortly after this to bridge the gap up to take out more sell liquidity lines. And remember, if you're in a bias where it's actively seeking out one type of liquidity, it typically isn't really that big of an issue for that to happen. So you'll see that bias that I'm talking about, it'll take out liquidity, push down. Sometimes if there isn't liquidity there, it will form a box to give new liquidity and then take that out and kind of keep propelling it on down to, potentially even these buy liquidity lines down here at the bottom. Sorry, just reading some of the comments coming through. Anyhow, so you can see we had an interesting snap on some of these like Australian and New Zealand pairs last night. I haven't actually checked what that was about, but it definitely cleaned out a lot of a lot of long orders that were in here. That was pretty interesting. Came fairly close. It actually ended up being one of those entries. It stopped a few pips off of a liquidity line by and passing an expansion. But anywho, that was kind of out of nowhere, so can't really do much with that. Typically, it's not going to do stuff like that, so we're all good. Let's go ahead and move over to Euro NZD. So this one on our daily, I'm sure you can see again that we had a rotation off of the daily expansion line, and then we started slowly creeping down. And when I say slowly, I mean really slow. It's formed a lot of boxes on the hour, just kind of whipping down. But either way, it's this pair's had a lot of movement. So kind of in here, we had for an early warning sign of a potential turn long, be wary if price struggles to stay below the bottom of the contraction box. So let's jump over to Euro NZD. So we can see bottom of the contraction box, and it had a little bit of a hard time staying below. That's typically something that you want to see. You know, if you have a rotation, it should really just take off right after that, and especially first thing out of a box. You want to see it be able to stay just below the contraction box at the very least. And it's all right if it whips around that level a little bit, but you know, ideally you really want to see it break away. So we got that early warning sign, and at this point we have got a bias to some of the sell liquidity lines. Yeah, and looks like we had a nice little entry here on the 15-minute where it took out a buy liquidity line, or excuse me, a sell liquidity line, came down, rotated right off of an expansion, and then continued that bias. So seems pretty likely that we'll at least come up to this point. And you know, it looks like on a little bit bigger scale of things, it looks like we're going to be headed back over to the daily expansion line. So we'll probably hit that and then go through a little bit of a breath right there, and then we'll figure out if we're going to rotate back down short or continue up long. Now, just to add a little bit more clarity, because I've been talking about this rotation on expansion lines. I believe it was pound dollar that there was a pretty good example of this happening. Yeah, so right here on pound dollar, you can go over to the daily and you can see that it was like it was one of those moves where you look at it and it's like, wow, how, you know, I really wish I was looking at that when it happened. But you know, we had a pretty clear example of it rotating, you know, off of an expansion line, coming right up to a liquidity line, and then you know it fell off a cliff. Obviously, we couldn't quite expect something like this, but this was actually featured on the volatility report. This was all kind of a result of a weekly average price rotation. Let me pull that up. Yeah, so right here. Yeah, you can kind of see what that trade turns into on when you find it on a bigger time frame. So you know, whipped up, came right up to a sell liquidity line, and then you know, kind of fell off a cliff right after. And it's always interesting when you see these liquidity lines and the candles kind of form like that on it. Very interesting stuff. Anywho, yeah, so I just wanted to point out, I get a lot of questions like, how do you manage doing some of these trades on a larger time frame? You know, how do you manage your risk, and you know, what are the differences? Honestly, regardless of what you're looking at, you know, if I covered up the weekly and told everyone that this was a 5-minute, I mean, it's pretty much the exact same thing. You're not really looking at anything being different. You outside of just managing your risk a little bit differently, in that you probably want to lower your lot size pretty significantly, just because you know what looks like a very small movement can be, you know, 15 pips. You know, the actual strategy itself on how you're going to pick your entries and your trades does not really change in here at all. You know, you want to find a bias, you want to find a reaction, and then be below expansion, and you know, be able to jump into a trade with your directional bias and find an entry on your smaller time frame. So like in this example of the 4-hour going into the weekly, we came down, that looks like pretty much the only entry in here that might have helped you manage this long, if you've been trying to catch any of this long trade. Looks like we had a little bit of an entry where it formed an expansion line, came down, very close to that, and then started pulling back up. So that's pretty much the only safe entry in here that I see. We'll have to see what comes out of this box right here, but oh, and then that's one more thing that I wanted to address. I'm going to hand it over to Wade here in a second, but I just wanted to address this before. um, so in the basic strategy, the main thing that you're trying to do is you have your directional time frame, which would be your bigger time frame. That gives you a stability to the direction that you're trading in. And then we've got our entry time frame. Everyone has got this. Um, Ideally, whenever you enter a trade on that, you want to be, so let's say you're trying to catch this short move, you want to be underneath your expansion line on your direction time frame, and you want to wait for price to rise above the most recent expansion line on your entry time frame. So you're trying to get them backwards for purposes of entry. That'll always default you to a much better entry than both of them being below. Sometimes it works out, but a lot of times it doesn't. So you always want to be above expansion on your entry time frame and below expansion on your direction time frame in the example of short, and then vice versa for a long. So anyways, with that, I think I pretty much have gone through the volatility report. I'm going to be in the comments going back through and answering some of your questions, and Wade will address some of them. But anyways, just wanted to break down some of the picks for the week and you know, what was going on with this. So that being said, I'm going to go ahead and hand it over to Wade. Thank you, guys.
All right, thanks for going through that for us, Shane. Appreciate it. Guys, give me 1 sec. I'm gonna get my stuff set up here and get my screen on. So give me one moment and we'll address some of you guys' comments here. I see some came through here, so hang on 1 sec.
Hey, Wade, let me jump in here just for a minute. Asking about entry trades and examples of that. I just want to mention, and by the way, this is Wade and Shane's dad. Shane put together in the forum, if you haven't checked it out, about 3 days ago, several examples of entries and screenshots and that. So if you're not using the forum, I would suggest that you go in there. I go in there and learn things. So I would suggest you guys do that. But look for that string that Shane put in there. It's trade ATS moderator, and it was put in 3 days ago. It might be very helpful for you. Thanks.
Yeah, Shane did an excellent job putting the post together in there, just kind of going deep on entries, because that's obviously, it's one of the biggest questions we get at support is entries. And it's not a simple one, because entries, you know, everybody wants to finesse the entry, and everybody wants to call the turn on the entry. So you never see a negative on the trade, but that's obviously, you know, not going to happen all the time. It'll happen sometimes, but not all the time. And so, you know, Shane went into it pretty deep as far as the technicals on finding entries and things like that. So you guys should definitely check that out. But one thing I will say about entries is that you guys always want to have, you know, you want to use good risk management. You don't want to over leverage yourself, and you know, regardless of what the charts, you know, are saying, you don't want to risk a huge percentage of your account on any one trade. So that's kind of a universal rule. And you guys, I know you guys have been trading a while, and you know, you guys know that. So hang on real quick. I'm still trying to get my screen up. So let me make sure.
You know, I wanted to add into that or just kind of bring something up real quick. As far as I don't know what's in the air right now, but we're having these little small bugs in some, like between the license keys. But also for those of you that go and check out the forum, we're having a bug that's affecting certain users. It was supposed to be fixed, you know, last week, and it looks like it's still affecting somebody or a few people. But if you have problems logging into the forum, just go ahead and log out of your account and then back in, and it should be able to load right up. It seems to be affecting people if they've got a browser that's not Chrome or Firefox or something like that. But you know, trying to get these things worked out has been a little bit slower. A lot of our, you know, our developers and everything are, you know, being affected by the virus as well. So our workflow is slowed down a little bit, which is definitely frustrating, but I'm sure most of you can appreciate that all going on right now. Anyway, so yeah, just wanted to bring that up. If you have problems logging into the forum, just log out of your account, back in, and then you should be able to click forum and jump right in.
Okay, so I should have my screen up. And let me see, I wrote down some questions, so let me read what I got here. Hang on. Okay, going back to a question about, let me see here. One of the first questions we had from Thomas talking about liquidity lines being in the way of your entry. I hope, if I apologize if I didn't read the question correctly. There's a bunch of questions that come through here, so I'm trying to make sense of them. But I think to basically what the question was talking about is you have your directional bias. Let's say you're trading the 5 and the 4 hour, whatever you're trading. Let me see if I can find an example of what I think was being talked about. Okay, so we had this big up run coming through here. Let me check the time on this. Actually, let's check it from down here. So this gives us more movement. So it says 3:23, 12 o'clock. It's 3:27. This chart may not go back that far. Okay, 3:23. Okay. So I think the question was basically, you know, if you have your directional bias, let's say you're long on the 4 hour, and then you basically get under, let's say you're trading against this expansion line right here. You pull back right here. We get down to this level of structure right here. We didn't quite get there, but you kind of know if you rip the turn right here, if you get below this level, it's probably not any good anymore. So you know you have the market framework to manage your risk off of. But let's say you're trading back up towards this, and I think the question was, what if you get in a situation like this where now there's liquidity lines, sell liquidity lines in the way of getting to your directional bias right here? So that was, you know, I guess the question is, should that be a deterrent to stay in the trade if there's sell liquidity lines have formed now? And I think this is kind of a common thing, is that sometimes a lot of people think that when a sell liquidity line forms or a buy liquidity line forms, it's almost like a signal that there's a reversal in trend. And they very well can appear where there is a reversal, but that's really not what they're for. This should not be a deterrent to keep working towards your original target. If you have those sell liquidity lines, because if you're still long, let's say you're long from down here, well, you're just kind of baking in this because ultimately you're looking to get through this level and test that level and then see if you could get beyond it, like what happened, you know, because this you're just expecting follow through on the 4 hour. So if you have those lines in your, those actually are good, because the liquidity lines, the biggest thing that you get with liquidity lines is you get they serve two purposes. They give you information about the progress of your trade, and they give you profit target levels, you know, potential profit target levels once you're significantly in the money. In this situation where you have these liquidity lines in the way, you got to ask yourself, you know, I'm in a long trade based on my directional bias on the 4 hour, right? From down here, let's say, on this rotation. If you have liquidity lines, those now present not obstacles, but they present threshold prices that a certain behavior has to happen at those levels to make your trade have progress. So if you're long from down here, now you're swimming down, okay, but we're still, you know, you're in the money, but the trade hasn't followed through yet. So you're just kind of sitting, you got these liquidity lines. Now we break out of this box. We're still shooting for this target price level. As this price is coming up right here, I'm gonna try to talk real slow right here. So as this price comes up out of this box right here, the question you need to be asking yourself is, if you have these liquidity lines in the way of your target price, is what happens at these liquidity lines. And if your expectation for the profitability of your trade and the follow through is to get to here, then what the banks and market makers would do to use this sell liquidity at this level, they would use it to boost the market instead of accumulate it and reverse the market like what happened here. So what you want to see, that's a good clue as to whether your trade is still good, is seeing that you don't get real heavy reactions at these levels. And in this case, you could see that the market just kind of climbed right up through them. So that's a clue into, is the market still good for my long position? And so that's what you want to look at those for, but you shouldn't let it be a deterrent. You know, if you see those form, you say, okay, forget it, I'm going to close my trade right here. You still have your risk management, you know, based on down here. You know, as you make progress in a long trade, you're getting framework as you go. So in this case, you know, if you entered long right here, I probably wouldn't have want to seen price come back through this level. So instead of having your original risks down here, I probably would have moved it to like right here under this expansion, and that would have protected a break even at that point. But so you're just kind of in between those two expansion levels and just expecting, you know, that you're going to break to one or the other. But anyway, I don't want to get off topic too much. That's pretty much what was meant, you know, by that. If you see any liquidity lines, remember liquidity lines, once you're significantly in the money, they become profit targets. And then they also are clues. They're clue levels. You want to see what kind of behavior is happening at these levels, and is it consistent with my original trading idea? You know, and it's just something to put together that puzzle as you go. That's what ATS is about. It's about giving you pieces of the puzzle in the form of contraction boxes, expansion levels, expansion lines, and liquidity lines. It gives you those in real time as the market gives the level, so that we are constantly, we're not tuning our indicators to conform to the market to make it look good after the session. We're dealing with the market in real time. It may not be pretty, it may not be easy, but it is what it is. So, you know, that's really what it's about, is just dealing with the framework and working with it as we go. And then seeing if those are giving us clues in that original idea that you originally came up with and took the trade on. So anyway, hopefully that clears it up. Okay, and a question from Michelle, that was one of the first ones that came up. What is the best strategy to focus on? Kind of basically, we're all sitting at home right now. I think everybody has some more time on their hands. I could tell by the attendance of the webinar. Webinars are we're getting a lot more attendance, which is nice to see as a side effect, I guess. But what is the best strategy to focus on right now? And there's really, if I had to tell you the most important thing about trading with action threshold software, if you can get good at one thing that would make the biggest difference, the one thing I would say is getting good at timing your directional bias. Basically what we try to do on the volatility report every week. We try to start trading when we're around a fresh box breakout, we're around average price, we have that proof of volatility, figuring out where your directional bias is headed, and becoming really good at coming up with ideas as far as, if it goes long, it's going to go potentially to this price. If it goes short, like I could tell you right now, if we stay short under this and we keep building price action, if I was looking at to come up with a projection of this directional bias, and it started to take off, it started to fulfill that projected idea that I came up with, I would look at, you know, I think it's reasonable over a certain amount of time that we can come back and test this level. We're obviously in a downtrend. You can see that. You know, that doesn't take a genius to see that on the long term. So if we do hold below, you know, I think it's very reasonable that we can get to here. And that's, you know, 285 pips away or so from where we're at right now. So again, I don't know if it'll happen, but it's just an idea. What you got to do is you got to come up with those ideas based on your higher time frame, and then you look for clues on the higher time frame and the lower time frame that reinforce the idea. And then when you get enough clues that reinforce that idea, you will eventually come to a point where you just have to take action. So again, that's that. If you had one important thing to focus on, it's about finding good ideas and projections for your higher time frame. Because when you do a really good job on your higher time frame, the lower time frame becomes much easier to deal with. Whereas a lot of people do the opposite. They look at the lower time frame because they feel like, I need to get in a trade, I need to have some action today, I got to make progress. and then they hope the higher time frame comes around and bails them out or reinforces what they're trying to learn on the lower time frame. So again, that's probably the most important thing you can get good at, is get good at figuring out the expansion on the higher time frame. And I know another question that came through, which is another thing about, what if it just breaks out? What if it just keeps going? It can keep going. It definitely can. And that you guys can trade this straight out of the breakout. If you have a box, sometimes we don't come back and test the expansion level. You can trade those levels, but that's where you have to look. You have to manage your game on the short term time frame. If you trade out of a box, coming down, and then you see on your short time frame that you're starting to hold above expansion levels on the short time frame. Let's say this obviously isn't the situation right here, but let's say you broke out of the box right here, and then you're getting situations like this where you're expecting the market to go short, but it's holding above expansion. That's a clue that you should, if you entered up here, that you should it's probably going to retrace back into the expansion range. So you have to use the lower time frame and the higher time frame to balance each other out and give you the clues that you need to predict the future of each time frame. But it does start with the higher time frame. On Aussie USD, sorry. Okay, on our Aussie USD right here, you can see right now we had these great long runs. If you're using the 4-hour for your directional bias, excellent runs. A lot of trades in here going long. But you notice that we pulled away here, and then yesterday's New York London session was basically these candles right here, coming out. And one thing that you got to look at, and when I'm talking about the most important thing, is timing your approach to the market on your higher time frame. We already had all these big runs come up through here on the long side. So eventually we're getting farther and farther away from this original expansion range. Doesn't mean to stop trading, but yesterday, if anyone was trading Aussie USD, it was a pretty choppy sideways day. There wasn't much opportunity there. And so what I'm talking about is is important for you guys to get good at, is get good in this area, and then get less and less aggressive the farther you go away, or just be careful. Now the difference to that is if you've banked a lot of pips and a lot of dollars in a run, because this one obviously we kept pulling and pulling and pulling, then you have earned the right, to trade through some sideways days to see if you can catch some winners like this, because some of these turn into big explosions. What I mostly want you guys to understand is I don't want you to watch these days and weeks go by where you have great opportunity like this, and I don't want you guys to start going heavy right here, saying, okay, that's it. Now I definitely believe it's going short. If you see it go by, the farther it goes, if you haven't traded it at all, or you just jumped on the pair and you're like, oh, look at it, it's running, that's actually not a good sign. That's not a great sign. You may catch a big winner and still get some big paydays on it, but as a general rule of thumb, you guys want to jump on markets when they're boring, when there's like not a whole lot going on, like in here, all this whippiness, you get a box like that, you wanted to get interested right here. That's where you wanted to get interested, or right here, or right here, or right here. And then we start settling out, starts building momentum. That's where you want to get interested, because that's where your decision point is, number one. And that's where, we got the volatility coming into the market. We've seen that because we got the breakout out of the contraction phase of the market. So we're timing that volatility. So I don't want to spend too much more time on that, but that if you guys are going to get good at one thing, it's really understand the timing of your directional bias and aggressively trade according to where you are in that timing. If it's far gone, if it's already ran 300 or 400 pips, forget about it. Wait till you get a brand new box, wait till you break out of that box, see what happens, start testing some ideas, testing a few trades, see if you can figure out where the direction's gonna go, and then start going heavy, get some out of the middle of the trend, And like I said, if you bank enough in the middle, then you can trade it till it's climaxed, till it's totally done. If you don't get any of that, forget it. This is where you time the market. You get it out around these expansion levels, pull some out of this leg, then you can trade this leg, you could trade this leg, and then you can give some back right here, and you don't really care at that point. But it's only if you earn the right to do it because you were early. So get good at that. Hopefully that makes sense. Okay, let me get to my next. Okay, we had a question from, hopefully I'm pronouncing this. I know we got people from all over the world, and the names I have sometimes hard time pronouncing, but I think it's Ertan. I'm gonna say, apologize if it's wrong. Question was, should we switch between time frames between the New York and London sessions? He says sometimes trading stocks, I'll switch between a 2-minute and a 5-minute chart to kind of figure out, what's optimized the best. If you've had success with that, switching time frames, and it just works out, then I would say if that's your habit and it's good, then keep doing it by all means. But as a general rule of thumb, personally, my opinion, I don't like to tell people to switch time frames around too much. I feel like sometimes it can add to the confusion, especially within one session. And I think it's probably mostly just dependent on experience. If you're new, I think my advice is stick to a 5-minute or a 15-minute. If you're trading in session, trade it into the 4-hour, and just get used to one time frame. Because when you first started trading, if you've been trading like under a year, your number one job is to just learn how to feel price. Just learn how to feel the movements of the market, and just get familiar with that. That's your number one job. If you've been trading 10 years, you already got plenty of price time, plenty of it. So you've probably spent hundreds of hours looking at a 5-minute chart. You've probably spent hundreds of hours looking at a 15-minute chart. So you just understand those. And ultimately, with ATS, what you want to do is you want to wait whatever time frames that you're trading. You want to wait until, again, you get a clear trading idea. Something has clearly formed that you understand, and then and then you use your lower time frame and your higher time frame together to find clues that validate that idea until the point where you need to take action. So that's really what you want to focus on. And that, you just want to wait. If you're trading, if you trade a 15-minute to a 4-hour, you wait until it becomes clear. If it is unclear, don't trade. Or if you got to put in a trade, put in a small trade that gives you a lot of flexibility to manage it, and you're not going to get cleaned out on some unclear idea that you had to test. So again, these are just decisions you gotta learn to make, and they're not easy by any means. But that is the reality of it. You have to learn how to make those decisions and figure it out. So going back to the original question, if you're new, I would recommend sticking with 2 time frames and don't change them very often. Especially in the session. If you pick a time frame, just stick with it, because just about the time that you're frustrated with a time frame is probably about the time that time frame is about to start working out really well. So you just want to kind of live through the ups and downs with a specific setup of time frames, because that regardless of what the time frames are, if it's a 5 into a 4-hour, that time frame will start setting up in a very clear way. May not be today, but it'll probably be tomorrow or the next day, or maybe 3 or 4 days in a row. So that's just my opinion. You guys could do whatever you want, but anyway, that's the less change, the better when you're new. When you have experience, then you can jump around and you can look for things that give you more clarity. But new people, if you're going to survive Forex, let's just survive and not get crushed. You guys need a consistent approach to the market that doesn't change every day. That's what ATS is about. That's why the boxes, there's no settings. It's the same every day. And the more you guys get familiar and get screen time with that same screen every day, repetition every day with that, that's going to be an edge for you. and that's going to get you on track. Well, the biggest thing that keeps people stuck in the cycle of doom, we'll call it, is their concept, especially when they're new to the market, is they're looking at anything and everything out there. I got moving averages, I got MACDs, I got this system over here. I'm running an EA, on a VPS. You got so much stuff going on because you're just desperately trying to figure out what is it, what's going to work for me. I'll tell you right now, you would be better off literally taking a 50 period moving average on one chart and never changing ever again. That would put you in a place to have more consistency than testing every system out there. So, that's my biggest advice, is just find something that has a consistent behavior, that has defined definition behind the events that happen. Like ATS software, everything has a defined event. We have a breakout, we have the expansion, we have liquidity lines, and that's it. It's actually 3 components, very simple. You have to find something that has a very simple, definitive process you could put on the behavior of the market, and then interact with that. And by not changing, you'll have that will become an edge for you over time. If you are so tempted to change all the time, I'm telling you right now, you will turn your learning curve in what could be, a year, will take you 10 years or 20 years if you're prone to changing. So I've worked with hundreds and hundreds of traders. Believe me, I've seen it, and it's difficult to struggle with. I struggled with it a long time. Nobody loved to test indicators more than me. I had a computer with probably 400 or 500 indicators on it. I was combining them. I was like a mad scientist in this room that we used to have at an older office. So believe me, nobody knows better than me, and spent a ton of money on developing stuff and everything. So anyway, hopefully you guys understand I'm serious about that advice. Stick with something that is consistent and just stay with it, because it'll have days that aren't as good, they don't line up, but it will have the days that it does line up, that you get it, that you're prepared. You'll be able to maximize those days, because you're going to be the best qualified to trade those days, because you've stuck with the same thing over and over again. So anyway, let me catch up. Okay, Rick had a question as clarifying the Market Maker's book of business, and I know you said you'd go back and watch the video, but I just want to talk about that a little bit again. What Shane was talking about, the expansion levels in those boxes. Market makers, there's what that is basically it's confirmed indecision in the market. So you have a lot of people trying to buck the trend, and you have a lot of people trying to enter in trend. So what ends up happening is you have an equalizing of buyers and sellers, and the market makers love those box zones. They love these zones because they're able to collect a lot of spread commission, and it's pretty easy business. But when it comes time for the market to move, the market makers, nobody understands true market sentiment better than the market makers, because they have that information filtering through algorithms on a constant basis. You gotta think about this. When you set up, when you buy the market or you sell the market, and then you set a pending order at your broker, that's a pending order in the market, a pending buy order or buy stop or sell stop. So essentially, you're giving them your battle plan before it ever happens. You're like, here, Mr. Market Maker, I'm going to buy right here, and I'm going to tell you with my stop order, I'm going to tell you exactly where I'm going to get uncomfortable about the trade, and I'm going to tell you exactly where I'm going to take my profits out of the market. Now that I've given you that information, you do whatever you do, and you're welcome. So it's kind of crazy, but in reality, that's what people are doing. So the market maker, that's why the markets, they seek out stop levels. It's the path of least resistance. And it's not just about your stop order, because a lot of people will say, well, I just don't trade with a stop. Well, it doesn't really matter what you do individually, because there's 10,000 other people that have the same beliefs And that's why the stops all cluster together. Everybody sees the same highs and lows. So it's going to seek out those levels regardless. So don't think like, what I'm saying, don't not run a stop because you think it's going to give you some edge. When the minute you have a belief in the market that the market's going to go long or short, and you act on that belief, whether you have a stop or not, you have some threshold price that you're going to get pushed to your pain point and close a trade, stop or not. And that's where that's the level the market is going to seek out, overall. So anyway, sorry, I keep getting off track. I apologize, guys. I get on rants. But going back to clarify Rick's question, the market makers, when they have these boxes, we get these confirmed areas of indecision, and you got a lot of buyers, a lot of sellers in those areas. The market makers know okay, here's where I was going with that. They know the sentiment of the market better than anybody because they see it. They see the true order flow. So when they understand that eventually this market's going to break long or short out of that box, so if the market maker is getting heavy on sell positions, they're taking the other side of those trades. They're not able to match them all up. And they know the market's going to break short, then it'll be advantageous for them to keep those sell positions. Okay, so like what Shane is talking about is in a situation like this where we break short, you go into that expansion phase, we come down below, and then we hold below that expansion line. We know that there was a bunch of buying and selling action happening in that box. And then as the market broke, it came back and it basically rejected. We had a rotation, it left behind. So we know now that there's a good chance that market makers were heavy on sell positions. And if market makers are heavy on sell positions, that's the smart money. That's the heaviest money that controls the floodgates, that we know there's a good chance of follow through to the downside because, there's no reason to take the market long anymore. They want to keep those sell positions. So that's what we're talking about. Same thing right here. You get down below, they hold below. There's no reason to take it long because they want to keep those sell positions. So, and it doesn't always work out. The market makers they actually have a pretty tough job because they're basically don't want to turn down business. They have, if you want to buy and the market is going up and they know it, they really don't want to sell to you, but they will. And so they eventually have to, it's a constant market making is like, you're just constantly, unless you're a really, really, really good market maker, it's basically constantly putting out fires and trying to balance your portfolio in a favorable way so you can get rid of bad positions you don't want to have. Just constantly putting out fires. So that's what we're talking about when they rebalance their portfolio. That's why these expansion levels are such telling price levels. That's why we rely on them so much, because we know it's a balance point. It's been defined in the architecture of the market. The market has told us what the balance point is, and we're just interacting with it. So anyway, hopefully that kind of clarifies what he was talking about and why we put so much weight, on those levels. So okay, let me see if I wrote any more down here. Okay, so I'm going to go through the feed for a second. Shane, if you want to add anything to that, feel free. I'm going to spend a minute or two reading. So we got a bunch of stuff in since then, but hang on, guys. Let me catch up here.
Yeah, I just wanted to bring up one little point about, there's a question in the chat regarding breakouts and kind of what do you do with them a lot of times. So you can see on Aussie dollar on the 4 hour that we had a box form, and then it broke out, and it was basically where it just broke out, didn't really stop or anything, and then just started heading down short. Typically you'll find that there was actually the entry leading up to that point. So if you just go back just a little bit, you'll see that snap up to the long side. It rotated right off of an expansion line, and then that was pretty much the entry. So again, typically when you see a breakout, a lot of time there will have been a clear entry that is in line with the three phases, and moving orders around like we saw there where it snapped through that sell liquidity line and then rotated, leading up to that breakout. Every now and then they'll just take off, but we can only, we're not can't see every order that's going on in the market. So I'm sure there's reasons behind that, but for purposes of what we can actually interact with and control our entry and our risk and all that stuff, there's typically an entry right before those breakouts happen. And if you made the decision to ride through that contraction box, then you would have been in it. But it's always a tough one to be able to figure out.
Yeah, it's there's always you got to look for those confirming clues to your, like I said, to the trade idea. There's typically, especially when you get those fresh breakouts out of the box, there's, let's just put it this way: if there's nothing, if you can't find an entry, there probably isn't a good entry. So no,
Or
again,
even a good trade.
yeah, if you can't find a trade, there's probably not a good trade. So, I think I said this last week, but remember, guys, out of everything that we can't control in the markets, we can't control when it moves, how big it moves. We don't have that control, but we can control when we push the button. And if you don't have something that is clearly defined that you can manage your risk on based on the architecture of the market, you have a point where, okay, here's the idea. This is my entry point, and then here's where that idea will be disproven. Risk first. Here's where I will be wrong. If it gets through this expansion level or it gets through this liquidity line level, this idea will not be working out in the way I think it should work out according to my directional bias or whatever the formulation of that idea is. You have that defined point, and then you have an idea of, if I'm right, where is it easily going to push to or very likely to push to? And as long as your wrong point is less than your right point, that becomes a valid idea. Now that you've come up with the idea, you look to your smaller time frame or your the multiples of your time frames together to find entry points and behavior that validates that idea based on the framework. So go through that process every time and don't chase the market around. There's nobody, because you can't control what the market's going to do, but you can control when you finally push the button. And if you do it on situations that are extremely clear and you can manage the risk in a very clear way, and you only pull the trigger on those, I know it takes a lot of discipline. I know it's much easier said than done, obviously, but that's really what it's about. That's when you'll start to feel like you're really getting control over everything, and you do have to work to maintain that. Even though you guys, I know you guys have been trading. There's some on here that have been trading 20 years, 30 years. We got some veterans on ATS, and you ask them, it's something. It becomes a habit more and more over time, but it's something that you have to continually work at your discipline. Even guys that have been trading 20 years can lose their mind every once in a while. So you really gotta it's something you got to keep it's like you got to keep mentally fit for. And that's one other thing I was going to bring up is if you come to the screen and there's something bothering you, let's say it's a family situation, or I know there's a lot of stress with this coronavirus stuff going on and the shutdown, and it seems we're getting new information, it's just escalating. I know it's peaking in other countries, thankfully, but here in the US we got a lot of anxiety about it, as far as the lockdown and how is life going to continue, and people losing their jobs and all kinds of stuff. But if you have any kind of mental stress before you get on the screen, you need to really take a moment and think about, should I be making financial decisions, of any kind, especially ones that require such quick, you know, quick analysis as trading. Should I really get on the screen? Because what you don't want to do is you don't want to be frustrated in some other part of your life and think that you're going to win in Forex to make you feel better. It's not going to happen. If anything will humble you faster, than anything else on the planet. It's trading. So you really want to make sure that you're in a clear state of mind. You're not upset. We call it delta. You want to be a delta, just neutral, not particularly upset, not very excited, very neutral. So then you can start processing the movement and categorizing it and coming up with those clear trading ideas. So I won't belabor that anymore. Another question here, do you recommend the 1 minute time frame? You can trade the 1 minute time frame. I will tell you though, it is extremely fast and it incites a lot of trades, but you need to look at the spread. Right now you can see we got on this account here, it's 1 point, basically a 2 pip spread. Look at the spread in conjunction with the overall movement. You can see that the spread, what you want to do is you want to be able to get into the money fast if you're trading a 1 minute chart. If you have a huge spread, let's just say your average move, let's say like a move like this is like 5 pips, because you could scale up the charts. You could make it look like it's bigger than it is. But if your average move is like 5 pips and you have a 3 pip spread, that's something you don't want to trade because you're at a huge percentage disadvantage just to try to get in the money. So but when the markets really start moving like they are right now, there's tons of opportunity with the volatility coming in the market, with the turmoil of financial markets right now. You do get some opportunities where, yeah, you can effectively trade a 1 minute chart, but just keep in mind, it'll probably, once things get back to normal, you're going to have to start moving back up and finding opportunities on the 5-15 minute. Typically in normal circumstances, I don't really recommend going below a 5 minute chart. You need to come up with a trading idea that has a big enough upside, and you're not really gonna, sometimes you can't weather those upsides on a 1 minute chart. There's just too many ups and downs, too much information coming at you, you need to be entering on a bigger time frame so that you can project forward an idea that has a minimum of 15 to 30 pips behind it potentially, and that you can actually stay through it because the time frame is less noisy. But anyway, that's my take on a 1 minute.
Hey Wade, since we've been having a lot of action, could you do a little analysis on euro dollar, maybe like the 15 into the 4 hour? I know we have a lot of people that are trading on that.
Yeah, we could take a look at it. Yeah, euro dollar's been, it's like the sleeping giant that has finally awoken. Okay, so let's do, I did an analysis on the monthly last week, but let's just we'll start with the day just to keep things quicker. Ooh, like that reaction point. Told you guys, expansion levels. It's the framework of the market right there. Okay, so we'll do that. Let's take 1 hour. Okay, so what do we got going on here? So possible, we're getting the reaction off the expansion level here. Actually, let me take a look at a weekly. Let's see what our weekly looks like. We almost got that same reaction point on the weekly threshold price right here, same as a daily. This one's got some indecision in it, but I will tell you, once it picks a direction here, probably going to get another pretty good sized run on euro dollar. So weekly candles long right now. I would say I would be looking right now on the daily to see if this weekly candle holds. One thing you guys have got to keep in mind too, is that, yeah, we have non-farm payroll coming out on Friday. So in the situation with that, you guys got to be careful on the weeks leading up to non-farm payroll, because sometimes we could get some pretty erratic movement. So just keep that in mind. But yeah, I would be looking to see, basically, let's just put it this way, if you're treating the daily as long right now, it looks like we could come back up. And if you're long on the daily, the candle's red, but right now I would be comparing the daily into the weekly to see if this weekly's in a whole green, because if it does, there's an excellent chance that we're coming back to here. So that's a minimum profit target. So that's 116.8 pips away. If that happens, I would like to see that we hold, right now we came down through this expansion level. you know, I'd like to see progress up through this level. So if you're in it long, let's just say, you know, I'd like to make progress, you know, and keep, you know, I don't want to spend too much time below this level. Let's put it this way. You start to spend time below this level, you know, chances are we could be retracing back to here. And that's a long distance. So, you know, on the 1 hour, that's what I'd be looking at. Another thing too is I see kind of the master pattern cycle playing out here. We have an expansion level here. So we broke high, broke low, broke high, broke low. So you can see that global expansion happening between those expansion lines. So that's another thing too that I'm looking at is to see, you know, up through this threshold price. This is a key level in this overall master pattern expansion right here. So I'd be looking to reference back to that. You know, you want to hold above this price here, and then next thing I'd look at is kind of what are we going to do at that level right there. And that's I would kind of just generally look for progress through those levels if you're looking to go long. But yeah, that's, you know, that's kind of how I'd be looking at it. But the daily is short, but it's the first day short. So I would see how we can affirm, because you do want to keep that in mind. You know, if this is a reversal here, again, you know, if this daily is going to hold, you got to think comparing the 1 hour to the daily, we're short, but we have framework over here. So in order for this to come back green, if we're betting on the weekly staying green, we got to ask yourself, okay, there's a series of events that need to happen for that to validate. Okay, now let's look at our framework on the lower time frame. If I'm long on Euro USD, right now, I would expect that we would see behavior where this maybe closes red, but tomorrow opens green and we start attacking this high again, you know, over the next day or two. That would be what, you know, what you'd expect to have happen. If that's going to happen, what are we going to do with this architecture? Well, again, what I already said, I'd like to see us hold above here. If we start getting reaction, we start tipping off that could be something where I'm like, you know what, forget it. I'm going to give it more time. I'll take the small loss around this range and give this more time, because if this does, remember, we are under expansion here too. So, you know, you got to keep that in mind. But that's managing this idea. So right here, that's your sweet spot to manage it around. But if we do start getting reactions, let's just put it this way. I wouldn't be willing to go on a bus ride down to here, because that could be potentially in the future of that. So with any trading idea you're coming up with, I don't care if you're trading against trend, with trend, whatever, you come up with the idea, the projection, and then look at that architecture and say, what needs to happen for me to be right? And we don't know how long it's going to take exactly, but we know the general behavior, you know, that we would like to see in the follow through of that idea. So you got to come up with some idea of that and the management points using the architecture we have. But that's how I'd be looking at it. You know, I see, like I said, based on the candle color, you got to be careful, but I do see this forming. Expand high, expand low, expand high, expand low. And now, you know, the question is, are we going to reverse or are we going to expand high? If we're going to expand high again, where are we going? Probably to this liquidity line. That's the high point of this master pattern right now. So we get to the high point, we can project forward, you know, to the expansion. There's about 120 pips. If we're wrong, we get below this level. You know, let's say you want to manage it to the high point of, you know, because we're holding this liquidity line level. You know, that's another thing. If they're using those orders at that liquidity line level to fuel the up move back to this level, then if the market does pull back, they're probably not going to want to go below that level, right? So let's just use that as a management point. Let's say you put your stop right here below on the turn. So right now you got a 53 pip downside if you're going to use that. Doesn't mean you have to wait. You may get clues in here that tell you I want to close the trade before you get there, but you have 120 pip upside. So now you're working with a risk to reward ratio within that idea. Will you be right? I have no idea. But the reward, the risk to reward is good. And if you see enough clues in your favor to take action on it, there's your idea. So you know, it's kind of a process of putting it together, and that's what I think. So let's look at the lower time frames on euro dollar. I'm gonna actually go to the 4 hour. We'll look at the 4 hour and we'll turn this into a 5. Okay, so 4 hours starting to rotate. And then again, you can see that same expansion we saw in the hour, expand high, expand low, expand high, expand low. We saw it much clearer because we had more framework on the lower time frame. But same thing, now we just tested this. So if you're trading long on that same idea, looking at the 4 hour, again, the follow through needs to happen on all the time frames. If the daily's coming around long, hour, 4 hour, everything's got to go long too. So we have a expansion level right here. We'd have to get through that level for sure to get up to that high. One thing that I see right here is we're again, if you were short on this 4 hour, there was some good trading just inside the color candle going short. You can see we were holding expansion levels. That was confirming the short side and coming down through, just kind of classic trading in that direction happening. Then we come down and now, uh-oh, what's happening? Is the 4 hour done? We had this spike down. Now what's happening? No more progress. Okay, now, uh-oh, look at it. We just blasted through this expansion. Now it's starting to disrespect expansion lines going long. What does that mean? Uh-oh, now we got a green candle on the 4 hour. Clues happening. All the way to the point where we disrespected these lines up here, just blasted right through them. What's that saying about what's the possibilities? I don't know for sure, but again, these are clues. Could this be a bigger reversal now that we've diagnosed kind of what's happening in this framework? Possibly. So,
Hey, Wade, I just wanted to add into that. Could you expand the chart just a little bit in height real quick? Oh, no, well, that in height. But one of the clues that, we're talking about as to a potential direction change, when we came down, we can see we took out that buy liquidity line on the 5-minute chart. Then we pushed up and then we came back down, and that entry that I was kind of referring to where it rotated off of the expansion line and did not take out the liquidity level, that would be a clue of kind of a big move about to take place. So we actually had that same entry on the way down. If you scroll over to the left, we had the same entry to the short side. So yeah, right there where it comes up above expansion and then bounces right off a liquidity line. So that move, the things that it represents, that it's protecting orders of a certain type, either a sell or a buy, that usually indicates movement. So in the forum post I did about this, I talked about it being kind of a chicken and egg situation. So that entry is kind of the chicken, and then the movement afterwards is the egg. You'll find in a lot of different situations.
yeah, this is
Wait, sorry. Usually whenever you see a good reaction to an expansion line, that is a good indication that something's about to happen. I mean, you can see it right there on the 4 hour that, we pushed up and then had a real clean rotation off of expansion. When we talk about settling on, out of the box, that's pretty much what we're referring to, where you get a very clear, reaction to an expansion line, and that kind of sets the tone for what your direction is going to be following.
yeah, absolutely. That the expansion lines and the reactions. Remember, guys, that ATS is about giving you a series of clues with definition to those clues, and we're looking for confirmations of our ideas of what's going to happen on the higher time frames. So, these types of things, when you get rotations, very clear rotations off previous framework, you got to ask yourself, is that in line with my consensus on the higher time frame, or is it against it? Same thing right here. If you guys entered, if you shorted, a rotation right at this point, you were down, we're short on the 4 hour. If you shorted a rotation, you're in the money. Okay, you're managing, and then we have a chance to go through this level of structure and it holds. If you're short, is that a clue for you or against you? It's pretty clear. So, in those situations, you're looking for break even and you want to sit out of the market. You're looking for, when you short or go long or short, you're looking for immediate, you're looking for progress through those levels in your favor. When you stop getting progress in your favor, you need to look at, okay, am I in the money enough to ride through some of this chop? Because it hasn't hit my profit target yet, but maybe you may be in the money. You may be up 20, 30 pips, and you're still got another 40 pips to go to your profit target, depending on the time frame you're trading. you know, that if you're in the money, you've earned the right to sit through some more noise. But if you're not really in the money and you're starting to get rejections off key levels that you need, it needs to go through those levels to make your trade validate. Sometimes it's a good idea to just take a break even and wait for more framework. Just depends on the situation. So anyway, that's kind of what's going on. But you got to be careful around these turns too. You know, you got to be careful. If this does go long and you're trading the 5 into the 4 hour, you know, I'd wait till you get above expansion and, you know, wait there. If the 4 hour takes off, and I mean, look at, you know, there's plenty of, I mean, look at, you know, it goes for a while. It has the potential, especially in a market climate like we have right now. So, you know, wait till it becomes clear. Okay, we got a lot of trade. I'm going a little bit long today, but I feel like we're on a good rant. So I'm going to see if I could take a few more questions here. Question about trading from, hopefully I pronounce your name right. I apologize if I don't. I think it's Asim. If the higher time frame is a doji candle, does that not mean we are trading a range on smaller time frame, which means very risky? Possibility, yeah. Personally, I don't really get too wrapped up, just my opinion. I don't get too wrapped up in candles of what they look and, you know, look like and all. That's why I use Heikin-Ashi candles personally, just because they smooth out the market. I'm trying to see the overall architecture behind the market and trying to sustain a directional bias without getting thrown off. And so sometimes, you know, definitely if a candle has a, you know, a wick and a foot on it like that, you know, for instance, like this candle right here, you know, or on the hour, or the 4 hour like this, yeah, what that means is you had a big whip back and forth on your lower time frames. It definitely means that, but you don't want to get that, you know, let's just put it this way. If you were just looking at this candle right here on your 4 hour, that would tell you, oh, I'm in a ranging market, I don't want to trade. But you can trade in a ranging market because if you're referencing the cycle based on this box and this expansion line, even if you're in a range, what this means is that if it's ranging on the 5 minute, you just want to trade the upside of the range. You just want to stay long, stay long, stay long, stay long, stay long, because you're still above that threshold expansion price. So you don't want to get too wrapped up in any individual candle. You want to get wrapped up in the cycle, the framework. What's this framework telling me? Because if you could figure out the framework, that individual candle, you'll predict the future of that, you know, without a problem, because you're looking at a much bigger, something much more significant to base your decision on. All right, I'm gonna look for one more question, maybe two, and then we'll wrap it up for you guys.
I wanted to touch on one thing while Wade's looking for some more questions. When I was going through doing the volatility report yesterday, I don't look at any of the exotic pairs because most of the time people aren't going to really be trading those. But I look at all the majors and minors and, you know, kind of the more normal pairs. A lot of stuff was setting up, you know, a lot of things were in a box. There was quite a bit to choose from. We chose the ones that seemed a little bit more mature, weren't just like the first candle out of the box in most cases, where, you know, where we were potentially getting a reaction to the expansion line, or, you know, getting a little bit more framework built out of them. But remember, the end of this week is like non-farm payroll and stuff like that. And, you know, considering everything that's happened this month, it's probably going to be a pretty crazy one. You know, so my kind of assumption just going through to do the volatility report is that we're probably going to see the result of a lot of the movement later on this week. You know, I don't know what the news is going to be. I don't know if it's already baked into it, or, you know, what any of that's going to be about. But yeah, anyways, I think that we're going to see a lot of setting up throughout the week, based on what I saw with the volatility report, and then it'll all come together and make sense on Friday, and, you know, maybe the first few days of next week. So anyways, just a quick comment about that.
Okay, and then just to wrap it up, I'm going to address one last kind of basic question from David. Does a taller or shorter box tell anyone anything? You know, the size of the box, skinny or no box? Does it mean, why do some expansion lines stretch out more, some stop when others touch? Okay, so the box size doesn't really mean anything. It's all contraction phase. So don't get too wrapped up in how big the box is. That's again, it's not super significant. And then also on ATS 2.0, the boxes resize. So as the markets, it'll start, looking at one size, but if the market cycles into a tighter contraction within that box, the ATS is always looking for the tightest contraction point. Based on our algorithm. So, it's the boxes could start out bigger and then resize a little bit before they break out, just to give you a more accurate defined zone. So anyway, don't get too wrapped up on that. It doesn't matter how long they are, doesn't matter how big they are. They all mean that what you need to be concerned about is when you get out of the box. That's when the work begins, is trying to read the market based on your higher and lower time frame. And the expansion lines, it's a pretty simple programming that we did. Basically, the expansion lines extend until you get a new expansion line. So we're trying to track the current cycle. We still want to look at the previous levels, but when you're dealing with it, you'll notice that this expansion line ended the minute we got this one right here, because we want to focus on this is the most recent expansion level. That's our threshold price that we're dealing with on this spike. And then we want to reference the framework of the previous levels to figure out, what the story is. But that's why they stopped, because if we just left them all going to infinity, the whole screen would be covered in white lines and it'd be a jumbled mess that we couldn't make sense of. So anyway, that's it. So hopefully that answers your question. And if I missed any of your guys' questions or anything, always feel free to send questions into support@tradeats.com. And we're more than happy to help you guys out that way. Other
You know
than
what,
that,
Wayne, I just wanted to clarify that real quick regarding the boxes. So when it'll form a bigger box, and then you'll see that the boxes get a little bit smaller. Basically what that is it'll hit criteria to form a contraction box, and we get a big box. If we hit criteria for another box before leaving the price range of the pass box, then it will shrink it to the new high and low of that contraction. So it resizes if we hit criteria for a box again before breaking out, so it's basically zoning in on where the contraction is really taking place. It's not really it's not like a repainting. It's just getting tighter and literally more accurate as as it goes on. So anyways, I just wanted to clarify that.
yeah, it's a dynamic function. The ATS 1.3, the older version before this, it didn't have. So that was actually on a upgrade when we moved to 2.0. So anyway, it's actually quite cool. So if I do say so myself, I really like how the boxes resize. Other than that, I think that's pretty much it. So I want to thank you guys for your great questions. I feel like this was a decent webinar. Hopefully you guys got some good thoughts and things that you guys can put to work. Just to kind of keep you guys updated, we are looking to get, hopefully, right now our coding team says that we should have something to look at as far as our new licensing system that will eliminate the current licensing, so you won't have to update your license keys. We should be getting something, I believe, on the 6th, is what they're saying. So I'm looking forward to getting that. And we're gonna beta test it very quickly and get it out to you guys as soon as possible. And also right quickly after that, we should have the upgraded version for the next version of ATS, which is going to have, if I can get it all done, it's going to have a money management feature that's going to be pretty cool. It's going to have the ability to switch between Heikin-Ashi candles. It's going to have standard Japanese candles, and then it's also going to have a hybrid candle, which will be basically a standard candlestick that is colored like Heikin-Ashi. So you'll see the consistency in the color, but you'll see the candle bodies as standard candles. So anyway, that'll be coming. And then, okay, Benjamin just asked, I was going to comment. And then the expansion index is pretty much done. But the reason we're not releasing it yet is because we want to just do it kind of all at once. And also too, we don't want to release it until we have our new licensing stuff in process. So it's there, but again, like I said, we're not going to put it out until we can put it on the more secure cloud licensing network. So anyway, that should all be coming out. So I would say I don't know, I should be able to get you guys an exact date here coming up, probably in the next week or two of when you'll actually be able to get your hands on this stuff. But as of right now, and also too, like Shane mentioned, some of this crazy stuff is kind of put a dampen on some of our coding guy, actually all of our coding guys. They all work remotely and they're going through different things, and so we're trying to work through the situation with everybody, and anyway, it's slowed things down a little bit, but anyway, we should have something to look at for us at by the 6th, and so I'm hoping it won't be too long after that we can get it out to you guys, and you guys keep going. But I will tell you guys, the framework, when we come out with upgrades and things like that, that what we're doing here is not going to change as far as the methodology, as far as the 3 market phases, the boxes, all that stuff. It's the same thing. So you guys have more than enough on your screen. You're not going to need some latest and greatest. We're not going to come out with, we're not going to be coming up with stuff just so we can find something to sell you guys. That's not what we're about. Okay? I'm the only way that you're getting something from me is if I feel like it's actually extremely valuable and it's not going to cause you extra confusion. It's going to be a complement to the system. And so we're not just trying to put out stuff just to, for the sake of it. We want to really make sure that the stuff is good, because again, our goal here is to keep long-term subscribers, the people that get it, and not everybody will, but the people that get it and want to spend time with the methodology and understand, they value the fact that it doesn't change and gives you consistent framework of the market, and those are the people that we're looking for. So our goal is to keep you long term. I'm not interested in people coming in for 30 days. I mean, you can if you want, but it's we want you guys to, it's going to take you, I'll tell you right now, if you're new, it's going to take you probably 3 months just to start really understanding the market from this perspective. Maybe quicker if you've traded a lot longer, you have more experience, but 3 months, I know we're a month-to-month deal, and that's what we never want to lock anybody in or charge anyone a huge amount of money if trading just may not be for somebody. They may just have a discipline problem. They may just, they just can't do it. It's not for everybody. It's kind of a hard business. Is it worth figuring out? Yeah, I think so. But it's, you got to be right for it. So, we have the monthly deal where you come in at 150, test the water. If you find value from it, stay. If you don't, leave. It doesn't hurt our feelings. But what we want to do is we want to find the people that get it. And our long-term game is to have those people be with us for a really long time. And then that makes sense, from a financial perspective, over the course of time. It doesn't really make sense up front because we can sell this obviously for a lot more money. But that's not our game. We really want to do our best for people, and we want to make it easy if someone does find value, from it. And, we want to make it where they can go at a month by month basis. And sometimes people have to, we've had a few people unsubscribe just because they're squeezed right now. And we told them, you know what, go ahead, we'll be here for you, especially if you've already subscribed, you're already, shown that you've tested out the methodology. We'll be here for you to go take care of your family, go take care of your life, while things are crazy. And trading's not going anywhere. It'll always be here, and we'll be here for you. So anyway, that's what we want, guys. If we release you guys something, we want it to really help. We don't want it to create confusion. And overall, don't think you need to wait for that stuff to come out to get it. What you have on your guys' screens is plenty to to make good trading decisions with and work out what's going to happen. It just takes time and getting used to, and you got to stick with it. So, anyway, I'll leave it at that, guys. Thank you guys so much for being on, and really appreciate it. And we'll plan on seeing you guys for the webinar next week. So we'll see you Tuesday at 10 a.m. Pacific Standard Time. Everyone have a great rest of your day, evening, or afternoon. We'll see you guys later.